Welcome to part 2 of the Connected Business series on trading in turbulent times. I'm here with Dushyant Sharawat, and we're going to be talking this time about buy-side trading. So tell me, what exactly is buy-side trading for those viewers who don't know?
Absolutely, Paul. So buy-side trading on the investment management side of the business, as opposed to the sell side of the business, is essentially asset management companies. So think about it as big mutual fund companies like Fidelity and T. Rowe Price and State Street. And the sell side is obviously firms like Morgan Stanley and Goldman Sachs. What we think about as Wall Street companies. So that's, when you say buy side, you're talking about investment management industry.
Right. So what are the issues that these investment managers face as traders? What's changing for them?
So great question. And in fact, we've been doing a lot of work around this area the last couple of years. The big change that's taking place on the investment management side is actually in the trading desk, where buy-side trading is going through a revolution that's been taking place, I'd say since about 2001, 2002. And essentially what's been happening is that investment management firms are taking greater control over their own execution destiny, which otherwise means that in past years, let's say through the 80s and the 90s, investment management trade desks essentially outsourced the trading function to sell-side firms. The last 10 years, they're taking control back because of a myriad of different reasons. And they're taking more ownership of their own trading themselves. A couple of things that are happening there. So if you look at an investment management company, the essence of investment management is making investment decisions. And the idea of making investment decisions, obviously, is to generate alpha or to generate investment gain.
Yeah.
Important part of generating alpha is not just picking the right stock, but being able to trade it effectively in a volatile market.
Right.
Especially important if you're trading in international markets where the float in a stock is fairly small. So you can, as a large money manager, really move the market against you.
Right.
So a good
simply by trading.
Absolutely, simply by trading. What's called, market moving against you.
Yeah.
Are they through information leakage or market manipulation or market movement away from you?
Right.
So the investment management desks are using great amount of technology to manage around this. The other major theme is collaboration within the buy-side firm. In other words, the investment management trade desks are collaborating more with the investment management team. So the investment management portfolio manager is not making the decision to buy or sell Microsoft in isolation with the market conditions that are existing today when the trader actually needs to go and buy that stock. So there's a tremendous amount of collaboration and tools and software supporting the collaboration between the portfolio management of the investment staff and the trading desk.
Now, when I think about collaboration, I think about Microsoft SharePoint, video conferencing, Skype, those sorts of things. What are we talking about in this trading environment?
It's a lot more sort of multifaceted collaboration. It's collaboration as simply as placing face-to-face collaboration, so helping people work better together, so cultural integration between these groups that on the buy side historically have been fairly separate. In fact, for most large mutual fund companies, the trading desk is on a completely separate floor than the investment department. So breaking down those cultural walls, that's one element of great amount of collaboration. It's obviously a great amount of tools being utilized to help collaborate with these firms. They are software companies, hardware providers, connectivity providers that have made huge advancements. Again, examples of firms in that area are trading providers like LiquidNet that runs an execution venue. At the other side, they are providers of technology and services like IPC, for example, that provides trading turrets and connectivity. They're doing a tremendous amount offering up collaborative tools, helping the trader collaborate better with their portfolio manager. All of that with the idea to generate more alpha. So everything focused around helping the firm make investment gains, not just by picking the right stock, but by trading the stock better into this market.
Intelligently, if you like, smarter.
Absolutely, and that's where all the intelligence that the buy side utilizes. You may have heard about algorithms, for example, which is basically software written to help investment management firms and sell side firms take advantage of the market conditions.
So, I mean, simplistically, if I don't want to move, if I want to sell a big chunk of stock and I don't want the market to move against me, I'm probably going to want to trickle it out rather than flood the market with a big
Absolutely. There are lots of strategies to do that. So the whole idea being that we're managing money on behalf of investors, and we want to make sure that we are not being taken advantage of as we execute these multi-million-dollar trades.
This is serious stuff. I mean,
this is very serious
we're
business.
talking billions.
Absolutely. If you look at it, and it's especially important because the market conditions we've seen over the last couple of years, the volatility in individual stocks on a daily basis could be anywhere from 5 to 50%. So you might have made a very thought out, careful investment decision, but that investment decision might already go wrong on the first day because you might be trading really against the market. In other words, you're trading way below the average price you could probably get on that stock. So stakes are very high to make sure that buy-side firms can not just make the investment decision correctly, but also trade that very smartly.
Great, thank you very much, Dushyant. In the next segment, we're going to talk about how, in a trading environment, a company can protect itself against the unexpected, against disasters and other risks. So please come back for segment 3.